Hold up, did you see what just happened? The moment we've all been anticipating finally arrived. The Federal Reserve just dropped that quarter-point rate cut, with signals pointing to 2 more cuts before the year wraps up. Now here's where it gets absolutely wild. Everyone and their grandmother thought the stock market was about to go absolutely bonkers. We're talking full-blown celebration mode, right? The logical thinking was simple. Lower rates equal rocket ship stock prices. But here's a plot twist that caught everyone off guard. The moment this amazing news hit the wires, something completely unexpected happened. The S&P 500, it went red. The Nasdaq also bleeding red. This wasn't supposed to be the script, folks. Then Jerome Powell steps up to the microphone and everyone's thinking, okay, now we're going to see the fireworks. But even after the Fed chair finished his remarks, the markets barely budged. Sure, we saw some minor improvements. The Nasdaq climbed back slightly. The S&P 500 managed to recover a bit, but they were still trading in negative territory. And get this, by the closing bell, when most traders were expecting a green finish, both major indices closed deep in the red. Talk about a reality check. Here's a kicker that most people missed. The market had already baked this rate cut into stock prices weeks ago. Professional traders don't wait for official announcements. They position themselves based on expectations. So when the surprise wasn't actually surprising, the market responded with a collective yawn. But listen closely, because this is where things get absolutely fascinating. What the market hasn't priced in yet are the massive shifts coming down the pipeline. We're standing at the edge of some seriously powerful market movements that are about to reshape the entire investment landscape over the next 12 months. The Federal Reserve's new direction is setting up scenarios that could create incredible opportunities if you know where to look. In this deep dive, I'm going to walk you through the cold, hard data that reveals exactly where the stock market is heading over the next year. We're not talking about gut feelings or wishful thinking here. I'm talking about historical patterns, economic indicators, and marketing mechanics that paint a clear picture of what's coming. Plus, I will break down the shorter time frames too. What should you expect over the next month, the next 3 months, 6 months out? I've got numbers, and I will share my professional perspective on each time frame. And here's something crucial most investors completely overlook. Different market cycles favor different types of stocks. When we're in a rate hiking environment, that's a completely different game than a rate cutting cycle. A pause period? That's its own unique beast altogether. I'm going to review which categories of stocks historically perform best during rate cutting cycles, like the one we're entering right now. Finally, we will talk about something that could save your portfolio from major pain: hedging strategies. I actually considered implementing a specific hedge position today, but I held back. I will show you exactly what I was thinking and why I ultimately decided against it. This decision-making process could be the difference between protecting your gains and watching them evaporate. This is going to be an information-packed session, so buckle up. We're diving deep into market analysis, historical data, and actionable strategies that could position you ahead of the crowd. Ready to discover where this market is really headed? Let's dig in. Here's a game changer that most people completely missed in today's Fed announcement. This wasn't just about a measly quarter-point rate cut. Honestly, a 0.25% adjustment barely moves the needle for your mortgage, your credit cards, or even most business loans. In isolation, it's particularly meaningless. But here's what's absolutely massive. The Federal Reserve just fired the starting pistol on something much bigger. They didn't just cut rates, they officially launched us into a full-blown cutting cycle. And that, my friends, changes absolutely everything about how we should be thinking about investments going forward. Let me break down what just happened using the Fed's own roadmap, the famous dot plot that shows where each Fed official thinks rates are heading. When you compare what they were projecting just 3 months ago versus what they are signaling now, it's like looking at 2 completely different economic scenarios. Back in June, Fed officials were much more cautious about 2025 rate cuts. Fast forward to today, and they've turned significantly more dovish. That's Wall Street speak for ready to cut rates aggressively. We're talking about multiple cuts expected next year, not just 1 or 2 token adjustments. And it gets even more interesting when you look at their 2026 and 2027 projections. Across every single time horizon, whether we're talking about the rest of this year, next year, or even 2 years out, the Fed has shifted into full accommodation mode. They're essentially telling us, get ready for lower rates as far as the eye can see. Now, here's why this matters so much more than that initial rate hike cycle that started back in 2022. Remember when the Fed began raising rates aggressively? That first hike wasn't just a one-off move, it was the opening shot of a systematic tightening campaign that lasted for months. Well, today's cut is the mirror image of that moment. We're now in the opening phase of a systematic easing campaign. Here's the kicker that makes this situation absolutely unprecedented. We are entering this cutting cycle with the stock market trading near all-time highs. Think about that for a second. Historically, the Fed cuts rates when the economy is struggling and markets are under pressure. But this time, we've got strong market performance and the Fed is cutting rates. That's like having your cake and eating it too. And there's another fascinating wrinkle in this story that could accelerate everything. Word is that one of the Fed officials, likely someone recently appointed during the previous administration, was pushing for much deeper cuts today. We're talking about someone who wanted to see 50, maybe even 75 basis points slashed in one meeting. That's aggressive even by dovish standards. Now, this lone voice might seem insignificant right now, but here's how Fed dynamics actually work. Influence spreads. If this official can gradually sway even one or two other committee members over the next few meetings, suddenly we could see the Fed becoming even more aggressive about cutting rates than what today's dot plot suggests. Remember, Fed committees are made up of people, and people's opinions can evolve rapidly when economic conditions shift. What looks like a measured cutting cycle today could transform into something much more dramatic over the next 3 to 6 months. This is setting up a potentially explosive combination for risk assets like stocks. Now, let me share with you one of the most underrated economic indicators that Wall Street pros quietly track, but most retail investors have never even heard of. This single data point has an almost eerily accurate track record of predicting recessions months before they actually hit. I'm talking about US heavy truck sales, specifically how many brand new semis are rolling off dealer lots each month. I know what you're thinking, truck sales? Really? How does that predict the stock market? But stick with me here, because this makes perfect sense when you think about it logically. Picture this. You are a long-haul trucker or a small freight company owner. You are considering whether to drop serious cash on a shiny new 18-wheeler. We're not talking about pocket change here. A new semi-truck will run you anywhere from $125,000 to $200,000. That's like buying a really nice house in many parts of the country. Now, you're only going to make that kind of investment if you feel absolutely confident about the one thing, that there's going to be plenty of freight to haul for the next several years, because that's how long it takes to pay off that truck and actually turn a profit. If you're sitting here thinking, man, the economy feels shaky, businesses are cutting back on shipments, and I'm not sure if there's going to be enough work to keep me busy, are you really going to sign on the dotted line for $200,000 loan? Absolutely not. You are going to keep running that old truck until the wheels fall off. So here's why this indicator is so powerful. Truckers are essentially the canary in the coal mine of the economy. They feel economic slowdowns first because freight demand drops before almost anything else. When businesses get nervous, they reduce inventory orders. When consumers tighten their belts, they buy less stuff, and all of that translates to fewer goods that need to be transported. Now let me show you just how accurate this indicator has been historically, and it will blow your mind. Back in 2001, we saw heavy truck sales absolutely crater. And what happened shortly after? We got hit with that dot-com recession. It was relatively mild, but it was definitely a recession that caught a lot of investors off guard. Then in the mid-2000s, truck sales started falling off a cliff again, and boom, we got the great financial crisis. One of the most devastating economic downturns since the Great Depression. More recently, truck sales plummeted right before the COVID pandemic hit. Now, you might argue that COVID was a unique situation, but the economy weakness was already showing up in the trucking data before anyone had even heard of coronavirus. There's one interesting exception that actually proved the rule. Back in 2015 to 2016, we saw truck sales drop significantly, but we managed to avoid a full recession. Here's what happened. There was massive debate among economists about whether we were heading into a downturn. The warning signs were definitely there. But then the 2016 election brought in pro-growth policies, major tax cuts, and a surge of business optimism that essentially pulled us back from the brink. But here's what's absolutely concerning about our current situation. Truck sales have fallen off a cliff again, and this isn't some minor dip we're talking about. This is a dramatic, sustained decline that looks eerily similar to those pre-recession patterns. The big question now is whether we can pull another 2016-style recovery, Or if we're looking at a more traditional recession scenario playing out over the next 3 to 9 months. Here's where this connects directly to the Fed's decision-making process. If Jerome Powell and his team are looking at this tracking data, and trust me, they absolutely are, it might explain why they are suddenly so eager to start cutting rates aggressively. Think about it, if you are seeing clear early warning signals of economic weakness, wouldn't you want to get ahead of it by loosening monetary policy before things get really ugly? This would mean the Fed is preparing for much more aggressive rate cuts than the market is currently expecting. And that, my friends, will completely reshape the investment landscape over the coming months. Alright, here's where we're going to pause this deep dive. Look, we've just scratched the surface of what's about to unfold in the markets. We've covered the Fed historic shift into a cutting cycle, we've analyzed that shocking market reaction, and I've shown you that heavy truck sales indicator that's flashing some serious warning signals right now. But here's the thing, there is so much more critical information I need to share with you. We still haven't talked about which specific stocks are positioned to absolutely crush it during this rate-cutting environment. We haven't discussed those hedging strategies that would protect your portfolio if things go sideways. And most importantly, I haven't shown you the historic data that reveals exactly where the S&P 500 and the Nasdaq are likely headed over the next 1, 3, 6, and 12 months. Here's what I want you to do. Join me for our live market analysis stream happening today at 9 a.m. Eastern Time. This is where we dive into the real meat and potatoes, the actionable strategies, the specific stock picks, and the data-driven projections that could make or break your portfolio over the next year. During the live stream, I will be taking your questions in real time, breaking down the charts that matter most, and sharing insights that I simply can't fit into a single YouTube video. Plus, you will get to interact with our community of serious traders and investors who are all navigating these same market conditions. Before you go anywhere, if this analysis has been available to you, and I mean, we just covered some pretty explosive stuff about the Fed and market indicators, please smash that like button. It literally takes 1 second, but it helps this content reach more investors who need to see this information. And if you're not already subscribed, hit that subscribe button and ring the notification bell. The market is moving faster right now, and you don't want to miss the updates that could impact your financial future. See you at 9 a.m. Eastern for the live stream. That's where the real fire content continues. Until then, stay sharp, stay informed, and remember, in markets like this, knowledge isn't just power, it's profit. Catch you on the live stream.